afternoon. This panel, I think, has had some great setup comments by some of the earlier panels and speakers. And what they want us to get some dialogue going about is what's changing in early stage capital, and especially how are we as angels and angel groups affecting how tomorrow's entrepreneurs are going to obtain financing. And we had a preparatory call that Brian and Paul organized before this session, and there was one point that I thought was particularly thought-provoking that each member of the panel had an opinion on. And the point we were discussing was how, over the next 10 years, venture capital and angel capital were going to change, and what that was going to mean to the people seeking development funding. And it's interesting because we've got a video camera here, which is a kind of a new thing in these types of meetings. And I'd like to suggest that we all think about creating some history today, right now. And what I'd like to do is ask each of the panel members to give us their opinion on what they see as the ratio of angel investment compared to traditional institutionally backed venture capital investment 10 years from today in 2020. And since I'm the moderator, I'll go first. I think, and in part to answer the question that was asked in the last panel, I think that in 2020, the amount of capital that angels will invest will be 4 times greater than traditional venture capital funds will invest in 2020. And I know that seems like a pretty radical thing to say because we've always been used to the fact that they're about equal. But what I see happening and is already underway is that venture capital, I believe, will be half as big in terms of dollars invested 10 years from now. And I think as the boomers enter their prime angel investing years, and as we get better organized and have more functions like this, that angel investment will double over the next 10 years. So I think those two combine to give us 4 times more angel money than venture capital money 10 years from now. And I was told there was people from the government in the audience, and they made me say that. But what I'd like to do, seriously, is ask each of the panel members to give us a view on how, if we could go forward 10 years, it would look. Antoine?
Good afternoon. Antoine Paquin, Row Ventures. Can everybody hear?
Yeah. Oh, sorry.
Antoine Paquin, Row Ventures. In particular, I'm a partner in the Canadian fund for Row. Row has been a top quartile venture investor since 1981, based out of Palo Alto, New York, and more recently Montreal. Jacques was actually kidding earlier that he brought me back from California where I had a nice surfboard that I can no longer use here in Canada. So, I bring a perspective of, I'm mainly an entrepreneur. My DNA is that of an entrepreneur. And I have been an angel investor, lost my shirt many times as an angel investor, learned some very valuable lessons in the process. And more recently, I became a venture capitalist. I actually like to joke that I'm a venture capitalist on training wheels still. But I would say that the venture capital model is a spectacular vehicle when it is applied properly that can create tremendous amounts of wealth. Having said that, in the last 12 years, in an environment of excess liquidity and way too much overinvestment actually in the asset category, we've seen the model completely corrupted by too much capital, where it stepped out of its natural boundary. It chased deals that normally would have never passed the bar, and quite frankly needs to be readjusted. I was actually arguing in our preparation that today we still have probably on a worldwide basis 5 times too much capital in the asset category to make it an efficient return vehicle. Also, as a venture capitalist, I often see a lot of entrepreneurs come up with some various degrees of business plans, various degrees of preparedness, and see often many companies that should not even talk to venture capital. And we typically like to refer them to angel organizations where the model is much more appropriate. And also see a lot of companies where, that are ill-prepared for the level of preparedness you need to address venture capital. I.e., when the question starts flowing, you better be ready to answer. In other words, you raise money not because you need to. You raise money because you're ready to answer very pointed questions on how you're going to self-measure in pursuit of a risky thesis. So I'd like to pass.
So Antoine, just in conclusion then, if venture capital is 5 times oversupplied, how do you see the ratio of angel versus venture in 2020?
I would argue that venture capital's roots is as an angel model. That fundamentally the venture industry is an industry of entrepreneurs, by entrepreneurs, for entrepreneurs. And as such, that there's part of the readjustment is for a lot more angel to reclaim, a lot of angels to reclaim the venture capital landscape such that it becomes a principal investing activity where people have money in a game and don't face the moral hazard of always investing somebody else's money in exchange for some management fees. I would also say that sometimes it takes a thief to recognize a thief. That an entrepreneur is probably best positioned, or an angel is best positioned to recognize the qualities in an entrepreneurial team that can build superior value. So I would say that angel is bound to increase, if not in size, at least in influence, but ideally in size relative to, as part of the adjustment of the venture capital asset category.